Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
John, exciting times. Exciting times all around. But this week we have a guest, and not just any guest, but someone we are both great fans of. John Authers, senior editor for market and opinion columnist at Bloomberg. He also has a brilliant daily newsletter, Points of Return, which I read avidly and plagiarize, and so does John. Of course, before Bloomberg, John was chief markets commentator at the FT, where he and I first met, and he is the author of The Fearful Rise of Markets. John, welcome.
Well, it's great to be here. I nearly wore my my pink shirt as to, from an FT alumni gathering.
Yeah,
but yes, it's delight to hear your voice again, Merryn.
Gorgeous. Now, listen, John, before John Authers, I ask you some questions. I just want to give our John Stepek, an opportunity to do something that actually he can do more often than you'd think, and that is to take part in the I Told You So section of this podcast. John?
Yeah. You see, I'm actually slightly embarrassed to say this in front of John Authers because I know that he would never do anything as crass or hostage to fortune as making predictions in the newsletter. But anyway, so mid-December, just after Donald Trump had appeared on the cover of Time magazine and rang the bell in the New York Stock Exchange, I tentatively suggested that there would probably be a 10% correction within 3 months on the US market. And lo and behold, we're here.
You deserve some plaudits for that.
Thank you.
Yeah.
Thank you.
Thank you.
John. I appreciate it.
This did look like a crescendo of sentiment. I mean, it felt a little bit that way, but you were too nervous to say, well, I was too nervous to say so at the time. But yes, that was a crescendo of sentiment.
Yeah. John got the timing right, whereas I've just spent the last 5 years predicting a 10% correction any second now. So John
Yes.
wins this one because he got the timing right as well. Why do you actually say it? Why didn't you actually say I told you so? It'll make you feel so good. Go on, just say it.
I told you so.
There we go. Right.
Well done.
Feels good. Right, John Authers, that is.
Me.
Yeah. You have had a ringside seat. I gather that you've been in Frankfurt recently. Tell us all about it.
Yes, this was very lucky. Last week, because there was an ECB meeting, and because I hadn't been to Germany since the pandemic, I thought, as I was on this side of the Atlantic anyway, this was a good opportunity to catch up in Frankfurt. So I arrive Tuesday night, and new or likely next Chancellor Merz and the Social Democrats have just announced they're looking to borrow an extra 900 billion euros. Wednesday and Thursday were some of the most remarkable days of my career in that obviously your average German financier is not exactly given to overstatement. These aren't voluble, excitable people. And they were saying without any kind of cynicism or sarcasm that this might even be bigger than the fall of the Berlin Wall, that this was a complete, total paradigm changer. You could forget all the research. I had this from a couple of people said, just don't ignore my research for the last year or so. It's inoperative. So it is that big of a deal. There's two elements to it. One is, and this is something I'm British myself. I certainly know I have a particular reaction to some of the things J.D. Vance has said in the last few weeks. But in Germany, it hits very much more painfully still. And I think the combination of what he said at the Munich conference and the way he bullied Volodymyr Zelensky, and I couldn't find anybody who thought anything other than the way they treated Zelensky was disgraceful. It just seemed to be a completely uniform reaction among often generally quite politically conservative and more generally small c conservative people that the US had just very plainly broken off, that they could no longer trust them. And in some ways it's even more of a compact that's been broken in their perception than was broken when the wall came down, which ended this division of the country and all those other exciting things. And then when it comes to financially, which is why all these guys I was talking to had barely had any sleep and why they were so excited. The bond market has been telling Germany for years that it can borrow more, and indeed that it should borrow more. It's the only major advanced economy that isn't borrowing enough, that anybody could possibly say with a straight face isn't borrowing enough. And most of these people had sort of, again, it was like, well, of course it would be fantastic if the East reunited in the same way. Of course it would be nice if Germany actually borrowed some money and did away with this debt break. But it was almost regarded as an academic possibility that economists would say was a good idea, but that was never going to happen. And somehow or other, just the extremity of the words and actions of Donald Trump and JD Vance in the space of a couple of weeks really does seem to have sparked as big a shift in the paradigm as anything we saw in when the wall came down. I mean, if you'd like to talk about the more markety things that are related to it, I've got lots of thoughts on that as well. But that was my main human reaction.
That's just true. Human reaction is great, but we would definitely like to hear about the market reaction. After a certain amount of time of American exceptionalism, and now we see this huge burst of money about to pour into Germany at the same time as America is pulling back. If exceptionalism is really about money, are we about to move into a decade or two of German exceptionalism or European exceptionalism?
Not being quite as bold as John Stepek, I'm not going to predict that with total confidence. There are some interesting parallels, though, in terms of you and I being boring and talking about value all the time. There is this fascinating combination that outside of the Magnificent Seven and the US, more or less the whole planet has looked like a fairly decent value. But Germany in particular. So the German economy is not doing anything great, but a lot of the big German companies, they're on a smaller scale, but they're actually generating profits as nicely as they ever did. So if you buy the stock, you find that the PEs are still very, very generous. So if you look at what's happened to, I had fun, this was in one of the recent newsletters, European value has outperformed US growth, if you believe MSCI, by 37% since Christmas Eve. So less than 3 months. There was this sudden sense of, okay, it's time to look for value. There was the catalyst that that value guys always want suddenly arrived, particularly in Germany. Germany happens to be where there are a lot of absolutely classic value stocks where you really can put some kind of a fundamental valuation on them because it's all stuff. It's all equipment and things they make. And so you've seen this very dramatic rise. Now, you've got to be careful comparing the Magnificent Seven phenomenon and and AI with .com because .com really was absurd, and this may turn out to be absurd. But in terms of the valuations, I don't think it is something qualitatively different. But if you look, this was a chart, I think it was Andy Lapthorne of SocGen, who's one of my favorite quant analysts, brought to my attention. And then I reconstructed it in about 30 seconds on the Bloomberg. So really, it was genuine. He hadn't done any. If you look at the stocks chemicals sector relative to the S&P 500 information technology sector, from March 2000 until the global financial crisis, chemicals outperformed US tech by about 500%. They trebled. Tech was down still about 40-50% by the time you get to the crisis. By the turn of this year, they had given all of that back. And US tech had finally matched European chemicals companies. You would have been better off in BASF than Microsoft. Well, I'm not sure about BASF. You would have been better off in BASF than a US tech index for most of the last 25 years. So is there a precedent for when money finally is jolted into moving, when there is this big catalyst, boring German companies making you far more money than sexy American tech companies? Yes, there is. That was a 7 or 8 year rally. If you were a bit late, never mind. You still, it's a nice, perfect, diagonal upward sloping line, and there was room for more as you piled in. And go on about this as much as I do. These German stocks started really cheap, and the concern for years has been that they're value traps. But again, these are things that make stuff. They're not as intangible as that. You do have something to grab hold of here. They are worth something. They've got these big factories. So anyway, I'm inherently careful about being too positive. And there are lots of things that, the history of large European power rearmaments isn't good, shall we say. It's not. So there are plenty. So in answer to the question, what could possibly go wrong? I think we know there are some pretty scary answers to that question. But cautiously, yes, I am quite a believer. In terms of the sentiment, the sheer excitement, combined with the absolute financial logic that's been there for years, this is quite interesting.
Yeah, and I suppose one thing to say is that the money has barely started to move. I mean,
Yes.
It doesn't. If you think about the weight of money that has gone into the US market over the last decade, and the constant removal of money from European and UK markets, it really doesn't take much of a shift for things to really start moving, as we've just seen. And it's only just begun.
Take 10% out of your Mag7 ETF and put it into a Stocks Industrials ETF, and that will move things very quickly. Yes.
That symmetry as well between, we've lived in a world where almost everyone's been talking about intangibles and digital and everything being clean. It's the same sort of thing that Ed Conway goes on about with the material world thesis. And so having that sort of perfect symmetry between stuff and, digitization is actually it's just another one of those fun market things that you see all the time.
Yeah, and nobody has ever mentioned anything about whether AI could help Rheinmetall.
Yeah.
Which is up something like 600%, to the biggest German arms manufacturer. We know why, but nobody's suggested, well, with AI, they can improve their profitability a bit.
Yeah.
Maybe they can a bit. I don't know, but this is just completely external to any great risk about the whole AI play.
Oh, yeah. And also, I mean, we've seen I think this is the other thing, because people get weirdly sort of scared whenever a turn comes, and they think, oh, have I missed the turn? And then you say, well, yeah, no, but remember that the tech bubble has lasted for about 10 years.
Yes.
So we're actually probably just very near the beginning of a secular trend rather than, we've already missed it because BAE Systems is up, X% or whatever in the last 6 months. So no, I think it's all part of a wider kind of rotation as well. Yeah. But it's interesting how you need these catalysts to make these things kick off. Because as we've been talking about for quite a long time, the US has looked expensive for ages and ages and ages. But it's that point where something happens to change the politicians' behaviour that then catalyses the shift in flows that you need to see. But I think it's really striking you saying that about the actual sensation on the market floor in Frankfurt rather than, because from here you can see it's a big deal. But it hadn't occurred to me, the idea about the Germans feeling, well, we thought we were being the good guys by not spending money on defence, and now you're criticising us for not spending enough. And that sort of message has finally got through to them.
And John, can I move us back to markets briefly? And back to the US market. We all believe, well, actually not all of us, but some people believed that there was a Trump put. And that after the S&P 500 had fallen a certain amount, perhaps even to John's forecast level,
Yes.
Trump would do something to make it stop because he feels that he is judged by the stock market. It's a measure of his success. Certainly wasn't his first term. Has something changed, sir?
I think the way he has continued with tariffs and been as erratic with them has scared quite a number of people that just the mantra with Trump in the markets has been look at what he does rather than he says. So he can say as many outrageous things as he likes. Basically, the first time around, he was a fairly orthodox George H.W. Bush style conservative Republican who did things the Chamber of Commerce liked. with a few exceptions, but broadly speaking, in terms of what he actually did, that was kind of what he was. And what he's doing at the moment is absolutely not that. It's complete. Might have need the word conservative applied to it in some different meaning of the word, but other than that, this is just not what he did before at all. So I think that did some damage to the assumption. I think the fact that he started with tariffs at a point when the conversation on taxes hasn't really even started, and where they're beginning to realize this is actually going to be pretty tricky to get through Congress, because the Democrats badly need this to fail. Obviously, they are completely entitled to say no, and the Republicans have no wiggle room at all. So it's from triumphalism to realizing, well, hang on, he hasn't even started doing this, and that's in large part because this is one of the things that's actually going to be difficult to do. Then there was the realization, well, actually, extending the TCJA, the big tax cuts from 17, isn't a tax cut. It's avoiding a tax hike because they expire and then reverse. And then making more cuts from there is going to be really difficult unless you can find some good cuts to the budget. Most sensible people look at the way that Elon Musk is going about his business and do not gain confidence. Obviously, there is an awful lot of waste to be taken out of the federal budget. Surely that must be true. Very few people who have a good understanding of management would think that the way that Elon Musk is currently going about it is the right way. So there's this combination of factors that, once you actually see what he's doing, has changed perception. And then on the issue of the put itself, I think it's quite interesting. In some ways, this is game theory, but you've seen a number of figures on the pro-Trump right arguing that there shouldn't be a put, and that in fact Donald Trump is about shaking up globalization and capitalism, and the companies that have benefited the most and whose stocks are up the most from globalization are the Magnificent Seven, are the companies that make up the bulk of the S&P. And the fact that some people have assets, but most of Trump's voters don't, means that this has stoked inequality. And so, no, Donald Trump actually wants the stock market to go down this time, even though he passionately wanted it to go up last time. I doubt that, because so many Americans have 401ks and IRAs and know very quickly if things are going wrong with it, because you get monthly statements. I think that's a little bit like the effect that variable rate mortgages had in the UK for a long time, that politicians need to be somewhat nervous about doing something that takes the stock market down, because it will make people feel poorer instantly, in the same way that raising interest rates would make anybody with a house feel poorer instantly. So I would question how far to take it. And it's possible that this is just... Oh, sorry, one other point is he does need to get everything done inside 2 years, because you assume they will lose the House at the end of next year. And there is also this belief that, and this is a perfectly sensible one actually, that there is a window during which you can blame Biden. Plainly, very little that he has done would be showing up in economic aggregates yet. You have a few more months in which you can say, well, this is just cleaning up Joe Biden's mess. So those are valid sort of political strategic arguments for really going for it early, being prepared to suffer a bigger S&P sell-off than you otherwise might have done. And it's like game theory, isn't it? It's like a commitment strategy. So we'll see. Plainly, as the market has begun to fall, people have re-examined their belief in the Trump put and have come up with reasons to be nervous about it.
Yeah. Well, thank you, John. We will see what happens next. Do you have any predictions to leave us with? Kind of guessing not.
I think you want the other, John.
If you could come up with a prediction, we'll have you on our "We Told You So" section in 6 months.
Okay. I can. The latest University of Michigan survey finds this. They very handily started 8 years ago. They started dividing everything by partisanship. So they would give you the data that independents, Republicans, and Democrats reported, and obviously this is because the political identification has now trumped all other aspects. The annual inflation rate expected by Democrats over the next 12 months is, I think it did actually top 5%. Forgive me if I'm wrong. It certainly surged up to a very high number. And the average inflation rate expected by Republicans, I'm absolutely certain I remember this number, is exactly 0. The average Republican thinks that inflation is going to be abolished over the next 12 months. My prediction is that isn't going to happen. That's wrong, that inflation will be positive over the next 12 months. And I'm really quite happy to book my champagne supper now to celebrate that. That's fair. Yes.
I think you'll find I didn't offer you a champagne supper. I offered you the opportunity to come back on the podcast. But thank you very, very much for that. Thanks for joining us. Really good to have you on. Thanks for listening to this week's Merryn Talks Money Debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. Also, John Authers at John Authers. This episode was produced by Summer Sadi and Moses Andam. Production, support, and sound design by Blake Maples. Keep the emails coming to merrynmoney@bloomberg.net. And don't forget to subscribe to all of our newsletters.